Welcome to Global Insights with me, Punita Kumar Sinha. Today we analyze Japan, the world's third largest economy. The Japanese economy has had a long period of recession. Its second quarter growth estimate has been cut in half. Exports have fallen, reducing the current account surplus by more than 40%. Low interest rates in Japan have not helped the economy recover in a sustainable way. What lessons can the rest of the world draw from this experience? Richard Koo of Nomura and Sanjeev Sanyal of Deutsche Bank will join me to discuss that and more. But first, let's take a look at how bad things really are in Japan. Nikhil Shivadas has this report.
2 decades ago, Japan was quite literally the land of the rising sun. It was the world's second largest economy and a force to reckon with. But today, Japan has slid to the third spot and is grappling with serious and chronic economic problems, including near-zero economic growth, deflation, huge public debt and rising unemployment.
In fact, its workforce is declining far faster than its population. So when we talk about stagflation in Japan, what we're talking about is very low output growth, very low GDP numbers, very, very low inflation, in fact deflation, which means that real incomes are growing.
That has taken a toll on everything from consumer spending to industrial production. The situation has gotten worse because of the slowdown in the US and China and the Eurozone crisis. Japanese exports and imports have been on a decline and the current account deficit has been rising, taking a toll on its already high public debt. One way out of this vicious cycle is to embrace inflation, but that would come with its own share of problems.
Well, if you did shift out in terms of higher inflation, what would that do to the bond yield? And therefore, wouldn't that spark a fiscal crisis, given the massive debt of the Japanese government? So being in this kind of coma that the Japanese economy has been in for a long time is one way of dealing with the debt crisis. And I don't think the Japanese are going to choose to break out of that anytime soon.
But if Japan does not break out of this, its financial health will deteriorate even further. According to the OECD, the Japanese economy will contract at an annualized rate of 2.3% during the third quarter and hover around a zero growth rate in the fourth. As Japan chases growth opportunities out of its own boundaries, India is ideally placed to attract investment. For one, Japan's relations with China are getting strained. For another, India is the only other Asian market that offers a consumer base as big as China's. So the bottom line is, Japan may manage to grow, but only outside its own geographical boundaries.
Joining me today is Richard Koo, Chief Economist at Nomura Research Institute. A respected economist, Richard has decades of experience in providing independent economic and market analysis and has advised successive Japanese prime ministers on how best to deal with Japan's economic and banking problems. Richard, thank you very much for joining us. You have coined the term balance sheet recession. In Japan, during this recession, we have seen that companies have deleveraged. We are seeing some of the same response by companies in US and Europe to the recessionary conditions. Do you think we will see a balance sheet recession like the one we saw in Japan, in US and Europe?
I think we are very much into balance sheet recessions in both US and Japan. It happened after the Lehman shock, when companies start realizing that they have too much debt, not just companies, but banks, households. They're all trying to delever at the same time. And they are deleveraging massively, at least in the US, 7% of GDP saved at zero interest rates. That's the kind of world Japan fell in. Zero interest rates, private sector is still saving money, minimizing debt, trying to repair their balance sheets. Same thing is happening in the US, same thing is happening in the UK, and in the Eurozone as well, yes.
Are there any similarities between the Japanese recession and with what's going on in US and Europe? And what are the differences?
In the world we are in now, and the world Japan was in since about 1992 or 3, is that at zero interest rates, the entire private sector is still saving money or paying down debt. And in that world, you can't bring any interest rates any lower, so that part is stuck. All the money that comes into the financial sector cannot go out because private sector as a group is no longer borrowing money. They're actually saving money, paying down debt. And if that's the case, all the money that returns to the financial sector but won't be able to go up because there are no borrowers, that becomes the deflationary gap of the economy. And if you do nothing to this situation, economy will continuously lose aggregate demand equivalent to saved but unborrowed funds.
Do you think that the U.S. recession will last as long as the Japanese one?
Well, I think we are very much into the Japanese mode of things, because in the Japanese case, the government did the right thing. In this situation, in the balance sheet recession, if government borrow the money and spend it, then you can keep the GDP from collapsing, allow the private sector to have the income to pay down debt. And Japan was doing that. But in the middle of it, 1997, OECD, IMF, those people who understood nothing about balance sheet recession in those days, together with a lot of academics, orthodox types, said, wow, Japan is going nowhere. Building bridges to nowhere, roads to nowhere, economy going nowhere. Why don't you cut the deficit? And Japan, unfortunately, listened to these guys, tried to cut the deficit when everybody else, everybody in the private sector was still paying down debt. And when the austerity measures were introduced, Japanese economy collapsed. We have 5 quarters of negative growth, complete breakdown in the banking system. And that lengthened the recession at least 5 years, if not more. Now, we see the same pattern in the US and the UK. Well, US, we haven't seen anything that bad yet, but the fiscal cliff that this country is going to face January 1st next year will be 3% of GDP. And the amount of deficit Japanese government tried to cut in 1997 was also 3% of GDP. 1997, Japanese private sector as a group was saving 6% of GDP. At this very moment, US private sector is saving 7% of GDP, also at near zero interest rates. So the situation is very comparable. If US economy falls off the cliff, I'm afraid US will have this very long recession to overcome. Now in Europe, that's already happening actually. Spain, Portugal, Ireland, those 3 countries, their private sector are very much in the balance sheet repair mode.
As you said, even low rates in Japan did not help the recession. So what would you recommend to the Fed or the ECB? Are you worried about further monetary stimulus in the US and the bond buying program in Europe?
Well, US and UK, of course, are still in the first part of the balance sheet recession, meaning that private sector needs to repair its balance sheets. And in those cases, government has to borrow and spend. And within that framework, Federal Reserve actions or the ECB actions, I'm afraid, will be only of marginal help. In the current situation, people are paying down debt without borrowing money. What that means is that bank deposits that private sector has will be smaller and smaller and smaller. And during the Great Depression, so-called money supply, the amount of bank deposits shrunk by 33% because everybody was paying down debt, no one was borrowing money. In that environment, I'm afraid, monetary policy is largely ineffective.
Right. So you like fiscal stimulus, where the government issues bonds and uses that money to spend on infrastructure, and you believe that actually it's helped Japan in the past. But we've not seen that happen in the rest of the world right now. So what is your view on that?
Well, in this environment where, as I said, money multipliers negative at margin, central bank printing money, it doesn't circulate into the economy. In that world, central bank can buy lots of bonds without having any impact on the money supply, which means it won't cause inflation. So all these talk that, wow, with so much money in the system, inflation is just around the corner, I don't buy that at all. Because when you actually look at what's happening to the amount of money private sector has to spend, it hasn't increased all that much, which is why inflation rates have remained low in all of these economies, in spite of what the central bank has done. Now, if government failed to borrow money, decide not to borrow money, money supply will shrink even further. Fiscal stimulus during balance sheet recession serves 2 purposes. One is to keep the GDP from collapsing because government is borrowing and spending money. The other is to keep money supply from collapsing. So in that sense, fiscal stimulus is very important in terms of making monetary policy work. And I think that's the key reason why, for example, Chairman Bernanke of the Federal Reserve, when he was asked by a New York Times reporter back in April, what are the contingent plans do you have in case the U.S. economy falls off the fiscal cliff? He said there's nothing the Federal Reserve can do to offset the negatives coming from the fiscal cliff. And I think he said it because he understands that if the government refuses to borrow and goes on to austerity, money supply will stop growing. It could actually shrink as well.
Richard, at this point, do you believe that the Japanese economy can only recover when the global economy stabilizes?
Right. You know, a lot of people are concerned about Japanese debt levels, government debt 240% of GDP, Japan's budget deficit is still very large. You know, people tend to look at these deficit numbers, and this is particularly problematic in Europe. Now, everybody's looking at the size of the government deficit. But in this instance, in what I call balance sheet recession, the problem is not with the government deficit. The problem is with the private sector. You have a private sector in Japan saving 10% of GDP at zero interest rates. In Spain, 5% of GDP at near zero interest rates. In UK, 7.5% of GDP at near zero interest rates. What kind of private sectors are these? These guys should be borrowing and spending money at zero interest rates. But quite the opposite. They're all repairing their balance sheets. And government is only responding to it by putting in a fiscal stimulus so that the whole thing will not come crashing down. And so, before we fix the government, we have to fix the private sector first.
Richard, in talking about the private sector, Japan needs to stimulate exports. But would that mean that the Japanese yen needs to weaken?
Well, you know, as you know, yen has been the strongest currency in the world for the last 4 years. And that has given Japanese a huge set of problems. I don't know what we can do about the situation. It's a very difficult one. I mean, if the Bank of Japan intervenes in the foreign exchange market, bring the exchange rates down, of course that would be helpful. But in the current world environment, where everybody has the same problem at the same time, and if one country tries to gain advantage, export advantage by trying to push its exchange rates down, all the other countries will have the same incentive as well. Even though Japanese yen is the strongest currency in the world now, Japanese policymakers are saying that, look, we should not be the one to pull the trigger. We should stay put. We endure it.
Turning to emerging markets, could they face stagflation like we've seen in Japan?
Well, emerging economies are in very different world. I mean, unless you have a massive bubble, housing bubble, and the bubble burst, a balance sheet recession will not be your concerns, I think. You know, balance sheet recession happens only after a major nationwide asset price bubble financed with debt bursts. And unless in India people are worried about something like that, or in Brazil people are worrying something like that, I don't think balance sheet recession is going to be a concern.
Richard, finally, what is the biggest lesson the world should learn from the Japanese recession?
If the private sector is minimizing debt at near zero interest rates, you must maintain fiscal stimulus until private sector balance sheets are repaired. That's the biggest lesson.
Richard, thank you very much for joining us.
Thank you.
And today we are focusing on the Japanese recession and the lessons to be learned from it. Sanjeev Sanyal, Global Strategist, Deutsche Bank, is with me to give us his outlook. Sanjeev, thank you very much for joining us today. We just spoke to Richard Koo, and his view is that fiscal stimulus was very important for the Japanese economy and that monetary stimulus is not very effective when the demand for funds is low. What is your view?
Well, Japan has serious supply-side problems, and as you know, Japan hasn't seen growth in 20 years. And throughout this period, they've, of course, done a lot of monetary stimulus, but they've also, throughout this period, also done a lot of fiscal stimulus. As you know, the government is now heavily indebted as a result of that. So just because you've got a few months of growth earlier this year, I don't think suggests anything about, a recovering Japan. Far from it. I think Japan will slow down very rapidly in the next few quarters, and this whole effort on the fiscal side will not really have done anything.
Sanjeev, what can help the Japanese economy recover?
I think there are several things. First of all, Japan has a serious demand side problem. But remember, a very large part of this is the fact that Japan happens to have a severe demographic problem, in that you have seen it's one of the first countries to begin aging very rapidly. And now you have a problem that the pipeline of human capital, i.e. the number of students coming up the education system through the colleges, through the universities, through the schools, is now rapidly diminishing. So I think there is a serious problem with the demographics, in addition to, of course, other structural problems in terms of cleaning up the past baggage of investment and so on.
So what solutions do you propose to solve Japan's problems?
On the demographic side, of course, the only short-term problem would be to seriously consider, opening up immigration. But even if even if you look at that as something that is socio-politically something that can only happen in the very long run, I think in the medium term the solution is ultimately got to be to weaken the yen. As you know, 25 years ago the yen was 250. Today it is at 77. At this exchange rate, effectively no Japanese exports are viable. And in an economy where, with an aging population that is not going to spend more, a government that is indebted, the only way you're going to generate demand in the medium term is going to be externally. Now sure, right now there is a global recession, but in the long run that's all you can really hope for.
If you had to predict where the yen will be over the next 10 to 15 years, where would it be?
Obviously, trying to predict over such long periods is difficult, but I would guess the yen would be closer to 150 5 to 10 years from now than it is to its current level.
Now, the stock market in Japan has performed very poorly for so long. What is your view of valuations in Japan?
Well, one of the interesting things about Japan is that while stock markets have not performed, the stocks themselves, on most valuation terms, do not look that cheap. I think ultimately a robust economy is not just about investing based on valuations. That can be true for certain kinds of stocks. But I think the big failure of Japan is its inability to throw up new companies. I mean, just look at America. I mean, in the last 10 years, it's thrown up so many new companies. I mean, just think about Facebook, Google, the return of Apple, and so on. Japan is, at least till recently, was the world's second largest economy. And where are Japan's Googles? Where are Japan's Facebooks? So I think reviving the entrepreneurial spirit of Japan is the real issue. Whether or not the pre-existing stock of companies is very well valued or not valued is, I think, really playing at the margin.
What lessons can the rest of the world learn from the Japanese economic model?
Well, the Japanese model was all about, initially, cheap labor, and that along with very heavy investment. And that model was then followed virtually by every Asian economy and is now currently the model for China. Now, the problem with the model for Japan was that at some point in time, of course, the demographics turned and labor became expensive. So at that stage, you couldn't keep deploying more and more labor. And of course, you had invested for so many decades that, in fact, you didn't have so much infrastructure and other things that you could continuously invest in profitably. This is precisely the danger for China. So I think the real danger for China is that it becomes a Japan. I'm not a votary of the idea that it's about to have a bust of some sort. I think that the longer term danger for China is more like stagnation rather than a bust. But again, I'm speaking talking a 5 to 10 year horizon now, or even beyond. I think for the moment China is in a fairly good position.
And finally, shifting to India. Can India learn any lessons from the Japanese economic model? I
think not just from the Japanese model, but from the other Asian model. The fact is, you do get a sweet spot of 25, 30 years when your demographics is right up there, and you have lots of things to invest in because your infrastructure is poor, and you can create this growth model, what you call the Asian growth model, and India could enjoy that over the next 30 years because India is now entering its demographic peak. But of course, this requires serious reforms on the supply side to get this going. But if we do, for 30 years, we could really enjoy it.
Sanjeev, thank you very much for sharing your thoughts with us. So monetary and fiscal stimulus is important, but structural reforms are also needed for the global economies in Japan to grow. And if indeed the yen devalues, it could also possibly help the Japanese economy. Now let's talk to Tanveer Gill and see what the other analysts and experts are saying about Japan. Tanveer, what is the data showing?
Well, Punita, devaluation of the yen is something that many are expecting on the street, but it hasn't really come by, and you don't know whether in the near future we would see that happening, because from a 3-year and a 5-year perspective, if you compare the yen to the euro, to the dollar, it has been the strongest currency. At the start of the year till now, there has been some weakness, and that's primarily been because data in the US has been improving on a relative basis. But broadly, you really don't know whether the yen would go weaker from here. The other aspect, and that's on the economy, if you just take a look at the real GDP numbers, projections for 2012, 2013, for 2012 end, Japan is expected to see some growth at 2.5%, but that's likely to dip to 1.3%. US is expected to be more steady over the next 2 years. So, one really needs to understand whether comparing the US to Japan is fair at this point. Even from a debt to GDP perspective, the projected numbers for 2012 end for Japan is expected to go from 220% to 240% by the end of 2012. And for the US, it's expected to go up from 101% to about 106%. So clearly, the rising debt on Japan's balance sheet will continue to weigh on the country's performance. And that brings me to my question for you, Punita. Put India into the picture, and how would you superimpose Japan's economic model for India, where there's slowing growth and rising inflation?
Tanvi, there are two differences between the Japanese situation and India. One is that Japan has had demand issues because they have an aging population. So even when there was fiscal stimulus and monetary stimulus, there wasn't enough demand for funds. Whereas in India, I think there's a very strong domestic demand story, and the demand side is not an issue at all because we have a very young population. I think the problem lies in the supply side for India, and the supply side constraints are what is causing inflation. So until the time inflation stabilizes, there can't really be much in terms of monetary stimulus to really help stimulate growth. And on the fiscal side, India has a big fiscal deficit problem. So I don't know to what extent the government can actually further stimulate the economy by some kind of a fiscal stimulus like the one we saw in Japan. So in that sense, the situation is slightly different, although I agree that growth in India is also slowing down and inflation is high, and therefore I think a lot of investment will need to happen in India, and overall investment climate needs to improve for that. And for that we do require some kind of reform to happen.
Oh, talking about investments, Asia Pacific allocations, how do you see the trend panning out there?
Well, historically, if you see, Tanvi, the returns from the Japanese markets have really underperformed compared to the other Asian markets. And that trend isn't changing anytime soon until we see some more signs of the Japanese economy recovering. And that might very well come from the yen weakening. And we obviously have to watch for that. But at the moment, as a region, most funds look at Asia ex-Japan, and Japan really falls in the bucket of the developed markets allocations. And within that, I think a lot of people are either underweight or neutral Japan. But given the significant underperformance of Japanese equities versus other Asian equities, I think the valuation of Japanese equities might very well be looking appealing to some investors. Well, that's my view. With that, it's a wrap on this edition of Global Insights.